This is Think Smart with TMFG, your weekly podcast of what's newsworthy and relevant to everyday Canadians, with your host, Senior Financial Advisor Rob McClelland, and Mike Connon of Asante Capital Management. Today on Think Smart with TMFG, Mike and I are going to be discussing why investors struggle with investment losses so much. Mike, this is one of the most important concepts in finance and investing. People struggle tremendously with losing money. The reason we're having this podcast this week is recently Daniel Kahneman, notable for his work on hedonism, the psychology of judgment and decision-making. He was also known for his work in behavioral economics, for which he was awarded the 2002 Nobel Prize. He recently passed away at the age of 90 in March. He was an expert in understanding human behavior related to losses. I get it with, sports teams. You win a game, you're excited, but if you lose a game, you're miserable. When the Leafs lose a playoff game, I'm pretty miserable for the next day. When they win, I'm happy. I may be excited that they won the game, and that lasts, I don't know how long, but not very long.
Not very long.
No, maybe by the next morning, I'm reading articles and I'm worried about the next game.
Yeah.
But investing is very different. And I think what's interesting for me is everyone has a story, but often we don't know what the story is. So we have investors come into our office, potential new clients, and sometimes there's a resistance to things that we don't necessarily understand. It may have to do with past investments that they've made, past investments that happen in their family, whatever it may be. There's always a history, and there's a struggle between taking on more risk because their fear of investment losses. And no matter how much you tell them, if we're diversified, we don't need to, over the long term, worry about investment losses, they don't get it.
So let's talk about behavioral economics. Just to our audience, some of them may not know what behavioral economics is. What exactly? Or give me an idea how it works.
It's not just the math. So the math is one thing when we're looking at investing and we're looking at human behavior. It's the things that we do that we don't necessarily know that we do. It's built into our behavior because of past experiences or things we've heard. And, you could have heard that your uncle was a millionaire and he lost all his money in the stock market. That, if you've heard that from a young age, let's say the age of 8, that you heard your uncle lost all his money in the stock market, what does that tell you?
Keep away from the stock markets.
It's bad.
Yep.
It has to be evil.
Yep.
My uncle lost all his money in the stock market. It didn't say how he lost his money. It didn't say that he had put it all in one stock and he was leveraged. It just said he lost all his money in the stock market. So the stock market must be bad.
Yeah. We saw that many times with, most of them are disappearing now, but we used to have some depression clients that grew up in the Depression. God, it was a different attitude toward money, wasn't it? Fear was like, we consider a bank safe. They didn't consider the bank safe.
They didn't consider anything safe.
They went to a time where they went to the bank and they couldn't get money from them.
So let's look at the way some of losses can impact your money emotions. So number one, it can cause panic in the markets. So if a lot of investors lose money, there can be panic in the markets and the market goes down even more than it should. So let's say the market was due for maybe a 10% correction. But investors get so nervous on that first 10% that they drive it down 20%. And what happens is the sellers are there and the buyers disappear because they're nervous too. It's not like there's all these people just waiting to put their money to work. They're getting a feel what's going on out there. They're reading it in the newspapers. They're hearing it on podcasts, on radio, on television, from their friends, cocktail parties, you name it. It's time to get out. And people get really scared of investment losses. They not only impact you then, but if you've lost money, it impacts your future.
Yeah. Well, it's funny when you see these articles and people's expected returns, it's funny how much they change from, if you ask everyone's expected return in a bear market, a lot of times people will be thrilled with 4 or 5%. Just to get away from the losses, they say, if I could get 4% or 5%, that would be just wonderful. But when you're in a bull market where things are going up by 15 or 20%, people would never even settle for anything near 5%. They want more. Everyone always wants more.
I think what's interesting to me is we see it on the faces of our clients when they come in for the meetings. We see it in the emails. And the questions are always around, after we've had investment losses, is this the right strategy? Is one question. Are these the right investments for me? Should we be doing something to prevent further losses? Because that sounds like a good strategy. Yeah. And what's happening here is because you've seen a number on a piece of paper worth less than it was the last time you looked at that piece of paper, in other words, the investment's gone down in value, it's triggering anxiety in you about your financial security. What if this keeps going down? Could it go down to zero?
Yeah. It's different because it's funny how assets work different than your home. Your home changes value all the time, but I've never seen anyone come into our office and say, I got to sell my home.
Right?
My home just dropped by 10. It was worth 1.5 million. Now it's only worth 1.3. We got to get out of here.
We got to get out because it could go down to $1 million.
Yeah.
So we have to sell it. One of the problems with losses is often they'll lead to what we call suboptimal portfolios. What does a suboptimal portfolio mean? For me, it's all about diversification. So we'll keep it really simple. We have a bond piece to the portfolio. We have a real estate piece, and we have Canadian companies, U.S. companies, and international companies. So let's say 5. More often than not, if one area is doing particularly poorly, let's call it Canadian companies, Canadian equities, investors won't want any more money in those companies. They'll want to allocate all the equity portfolio to the U.S. or to the international. Mike, does that make any sense?
Well, everyone forgets that when things have not done as well, means they're well priced. And that's what people get very confused at. Sure, the U.S. has been fantastic. But when you look at the U.S. markets, you have to pay for that. I mean, they've went up by 30, 40% more than Canada over a period of time. You're paying 30 or 40% premium on everything you buy down there. And sometimes that doesn't make sense.
What about holding individual stocks? Let's say you bought a stock at $20 a share, you own 1,000 shares, and it's now worth $10 a share. Have you found that investors struggle with liquidating that investment?
Very much.
Well, it's down by 50%.
Yeah.
So based on your logic, well, maybe we're buying it low. Maybe we should double down. And if you ask them if you want to go buy another 1,000 shares at $10 now that it's cut in half, they say absolutely not.
Yeah.
Then I say, well, why are we holding the 1,000 shares at $10 a share then? Well, it's got to get back to break even. Does that make any sense?
It's an emotional attachment people get to companies. And sometimes I understand because we have many clients with, let's say, overweight positions in companies they work for. And I can see that. You work for a company, you might have some commitment to it, over time. But sometimes it's just a stock that may have made the money, let's say 20 years ago. And because it made the money 20 years ago, it's a very different environment nowadays, but they still want to hold on to that company. And they're very different companies. Companies out there like IBM isn't really the same company it was 30 years ago. It's a very different company. And some people have this want to hold on to the company because they remember the beauty of what it used to be.
Today, we're going through a period of much higher inflation than we're used to. At least in the last 10 years, we've been in relatively low inflation. So we're now experiencing, anywhere between 3 and 4%. At one point, it was 6 and 7% inflation. That translates to a loss of purchasing power for those with investments. So if they're not in investments that can keep up to that inflation number, they're losing the purchasing power. So a simple example, you had $1,000. If you didn't earn any return over the year and inflation was 5%, now your $1,000 only buys $950 worth of goods. That's what the loss of purchasing power. And if you do that 2 years in a row, it only buys $900 worth of goods.
It's funny. You remember this stuff. My daughter got her license, right? So I'm out to go buy a car for her. And I haven't bought a car in a while, but you forget the price of cars changes with inflation, right? So inflation, as we've talked about this before, inflation on a day-to-day basis isn't very noticeable. But when you go 8 or 10 years before actually having to buy something, you notice there's a real change in those costs. And, if I want to spend, let's say, $20,000 before, and my money stayed at $20,000, I'm not going to be able to buy the same car I did 10 years ago, right? So the quality of the car is working down with time. So yeah, if your money doesn't keep up with inflation, whatever you're going to buy is going to be a lot less than you're buying previously.
The ability to deal with losses. That's what separates successful investors from unsuccessful investors. What do they say? The money moves from the money moves from the impatient investor to the patient investor.
Yep.
That's what that means. It moves towards successful investors, away from unsuccessful investors. Why are they unsuccessful? Typically because they got out an investment at the wrong time. People struggle with losing money. Another thing people do is they blame themselves. I should have known better. I should have known better not to buy Tesla because the stock was so overvalued and now it's down 30%. And that takes away your confidence and that hinders your future. So when you're impacting someone's investing confidence, the next time you go to make an investment, the next time you've got $20,000 that you want to invest, what do they want to do? If they've lost their confidence, Mike, what do they want to do with that $20,000?
Well, if they lost their confidence, they want it somewhere safe. They're not willing to take any risk. And again, it may not line up with the goals. So their confidence have changed, but the goals haven't changed. So again, they're going to make poor investment decisions.
I hear this comment the odd time from my daughter, one daughter that I have. And she says, I'll never be good with money. And I think I don't know where it came from. Maybe because she wasn't a math genius, because she didn't think with numbers. She just assumes that she'll never be good with money. But it's an attitude, and I've heard that from clients. I don't think we need to meet every 3 months because I'm never good with money. Therefore, let's only meet once a year. Does that make any sense? The only way to get better at things is to continue to work at it, to educate yourself a little bit, and understand that these behaviors that go on they're not normal. Well, they are normal. Everyone gets them, but they're not going to lead you to be successful.
I think the key when you look in the big picture is behavioral economics, a good thing or a bad thing. Well, it actually makes this job much more interesting because if everyone thought like a computer, there'd be no job for us. I mean, at the end of the day, because the markets would just have a straight return. The interesting thing about the markets, everyone thinks a little bit differently. And that's what creates the markets into this beautiful thing that takes all this behavior into account. But the only thing that you can do in your advantage, if you behave correctly, you can have an advantage over people that behave incorrectly. And you can have that wealth move from as you said, from the non-patient over to the patient.
Mike, one of our mentors, Nick Murray, often talks about what advisors actually do. And he said 20% of what we do is determine someone's goals, develop a financial plan, and put a portfolio together to meet those goals. 80% of what we do is investor behavior. And the longer I'm in this business, the more I completely agree. It's all about investor behavior. And if you can manage that behavior, control that behavior, you've got a really, really good chance of having a successful investment experience and being successful financially and meeting your long-term goals and objectives. If you can't control that behavior, that becomes really difficult. That brings us to the end of another week. Thank you for joining us. This is Rob and Mike with Think Smart from the McClellan Financial Group of Asante Capital Management, reminding you to subscribe so that you can have your best retirement ever.
You've been listening to the McClellan Financial Group of Asante Capital Management Limited. Asante Capital Management Limited is a member of the Canadian Investor Protection Fund and the Investment Industry Regulatory Organization of Canada. Insurance products and services are provided through Asante Estate and Insurance Services Incorporated. This material is provided for general information and is subject to change without notice. Every effort has been made to compile this material from reliable sources. However, no warranty can be made as to its accuracy or completeness. Before acting on any of the previous information, please make sure to see a professional advisor for individual financial advice based on your personal circumstances. The opinions expressed are those of the authors and not necessarily those of Asante Capital Management Limited.